Welcome back to Soar Financially, everybody. We're back from our summer break. Really appreciate you joining us again for an exciting interview. I'm really looking forward to this as well, because I have to admit, I didn't follow the markets too closely the last 2 weeks. Came back yesterday, looked at the markets, and didn't feel like I missed a lot. So really curious what my guest has to say about what is happening in the markets right now. What is he watching? What is he paying attention to? Because again, it's also Fed, I wouldn't say Fed week, but the Fed and other central bankers are meeting in Jackson Hole in Wyoming this week. So there could be some news coming out of there. Jerome Powell is to speak at the end of the week as well. I think it's going to be fairly quiet, personal opinion, but we'll see where it goes. It's definitely dominating headlines. I haven't introduced my guest yet. Let me do that. It's Ted Oakley. He's a managing partner and founder at Oxbow Advisors. Really looking forward to having him on. But before I bring him on screen, hit that subscribe button right there. And let's bring him on. Ted, it's great to have you on the program. You're a guest frequently on Fox Business and Bloomberg Radio. Thanks so much for making the time.
You bet, Kai. Good to see you.
Yeah, likewise. Thank you so much for joining us. As I said, it is a busy week. It's not a busy week. I'm still trying to make up my mind because I think the U.S. is back in school, and I'm looking for some impulses. Before we get to that, I want to hear what you think the economy is doing right now and how it is doing. Why don't we start there?
You know, Kai, we are in the midst of stagflation, really. You have an inflating economy, or have had. Not that it may not be going to end or something, but you've had an inflating economy, and then you have, on the business side, you have margins declining, you have earnings declining, you have people starting to get tougher to make money, and that's something that a lot of people in the business today never seen is stagflation. But I think you've got a good bit of that going on right now, and that's why you're seeing things that happen in the bond market, the stock market, and people can't necessarily make any sense of it. But that's where I think we are.
The S&P 500, since my last interview about 2 weeks ago, only lost about 100 points, trending a little sideways. It hasn't really tested any downward. I'm not a technical analyst, but it hasn't added any downward pressure. So is it just a lack of volume right now? People just waiting for an impulse, or you hinted at earnings? So I'm curious if that plays a role in that.
Well, if you look at the S&P right now, Kai, it's exactly the same price it was 2 years ago. But if you look at an investor looking at it, then you were getting less than 4 or 5 basis points. I mean, nothing on your money. Now you're getting 5.5%. You've got an 8.5% prime rate at the banks. All of a sudden, these companies are feeling the squeeze. It's just now starting to show up. But if you look at where the earnings estimates are of the S&P for the year, they're probably around right now. They've been lowered. They started out at 230, 240. They're down to about 215. We think they'll go lower, probably 200 or lower than 200 possibly. We think that's where we are. And effectively, I think people are there. It reminds me of 1987 in this respect. A lot of people weren't around then, but we had the same kind of summer. The market had a booming period between really the first 6 or 7 months of the year, and then as you got into August, everybody's they were just comatose. they weren't thinking about anything, and then all of a sudden, Greenspan, wanting to show the world that he was another Paul Volcker, kept raising rates, and he raised them so far to where everybody said, you know what, I'm out. That's sort of the way we feel like we are right now. I mean, you've had people play into these 10 or 12 stocks this year, and I think they're sort of in sort of a drunken stupor in one respect, because valuations don't match up right now with where the actual averages have been because of these 10 or 12 stocks. And so that's sort of our outlook right now.
Yeah, I just wrote down, you said booming period, but as you said, you qualified that as well. It's only 10 to 12 stocks. I'd say it was almost 7 stocks maybe, right? So what are the rest of the companies doing? Like if you look at the S&P 500, they're all underperforming massively, right? But why is the market not? It seems like nobody's paying attention to that. They're ignoring the fact that the underlying companies, let's say the other 490 companies, are just not performing. Like they're just ignoring that.
Well, that's what happens late stage in markets when you're in a particular move, and in particular, if you even take the Dow Jones, which has 30 stocks, but if you have more than a good friend of mine, great analyst, he's 84 years old, 83 years old, but he's great, and he was telling me the other day, he said, if you have more than a third of the Dow stocks, for example, underperforming, I'm saying down 25 or 30% or more, then that means that the rest of the Dow will eventually catch up. I happen to believe that is probably the case where people, I said we had a letter out in July talking about a camouflage market, and we felt like it's been that way really for 5 or 6 months now. It's just camouflage. The average investor, all they see on the screen every day on TV or wherever they look is what the S&P did or what the Dow did. Other than that, they really don't know what's going on.
They hear Nvidia everywhere, Tesla's doing well, Facebook and all those companies, or Meta as they're called now.
Well, they were. I mean, we really feel like those stocks, we feel like they peaked about 3 to 4 weeks ago, and we think they peaked for the year.
Wow. Okay, that's an interesting forecast, because I want to get to your sort of portfolio allocation and portfolio mix later on in the conversation, and how you're positioned, obviously going into into the fall here as well. But in your intro, you mentioned inflation, and we have to talk about that because I think it's a driving factor overall. I mentioned what's happening in Jackson Hole right now. Where do you see inflation headed right now? Where have we conquered inflation? I picked that term up, I think, in a Bloomberg article. Conquering inflation, is that even possible?
Well, it is when you get rates high enough. And if you look at when I say conquered, what's really happening is a lot of inflation numbers are coming in month to month now, not year to year, but month to month, very low, like 1 or 2%. And so a lot of lagging things, for example, rents lag a lot, and they're probably not in full force on the downside yet, but they're coming. It's starting, especially month to month. Oil has been up. That's expected at short term, but maybe you're in a position, we know we don't know. So maybe you're in a position where inflation has to settle in at 3% or 3.5%. And that's the new two, so to speak. I don't think they know either. But we're just I think you have to be in a position portfolio wise, so it doesn't hurt you either way.
And we'll talk about the portfolio, but looking at the inflation, just let's call it the curve, it feels like there's still quite a bit of downward momentum as well. Maybe even deflationary scenarios or disflation. Pick your term, I guess. But do you see like breaking through below 2% and even getting into negative territory here in the short term at least?
You could. It depends. It really depends. I think they're spending money they don't have. I think people are still, I think they're still somewhat drunk over the last 3 or 4 years when the money came in. And here's what breaks that, though. Let's say you have a market decline of, 30%, and all of a sudden, and certain people, and the economy slows down, people get out of jobs, all that sort of thing. Then one of the ways that companies make up for that is when they're trying to sell something, is they cut the price. If I've got a lot of inventory and I can't sell it, I'm probably going to cut the price. And we're not at that point yet, but we're getting closer to that point.
You mentioned inventory, and house sales numbers came out this morning as we're recording this. It's August 22nd, by the way. And they came in lower than expected. So, of course, the market is taking a hit there because inventories are low. That was my point. So I'm trying to have that inventory discussion, because when inventories are low anyway, let's say in the housing market, can prices even come down?
Well, they can. I was in an interview a couple of weeks ago, and I said, here's the breaking point. If the economy slows, and a lot of these people with a lot of these homes, a lot of them are 2-earner families, and one of those earners loses the job, doesn't make a difference which one, that changes the whole game. Because all of a sudden, a lot of people have bought more real estate, home real estate, than they should be in right now. I see it all the time. They've got a mortgage that's big. Yeah, it's a low interest rate, but they've got a home that's too big for really where they are in life. And what I could see happening is you get into slower economic times, and that's what will create more supply. Now, the builders on the other side, they've been playing the game of buying down the mortgages and being able to get people into these starter homes. And that's how they've kept themselves alive. But that ends too in time when things slow down. And I think that's where we're getting to. We're probably not quite there yet, but you can see it in multifamily and apartments. They're way overbuilding that group. And so you've got a lot of supply eventually coming to you on that end. And then one thing to remember is probably 25% of the homes that are bought in the last 2 or 3 years are bought by investors trying to buy the home and rent it. And that's slowing down as well. So all of that will eventually come around. And those investors that have those homes still have to pay taxes, still have to pay insurance, that sort of thing. And if they don't have somebody in that house, they're going to sell it. So I think that's where we are. We're just right at that cusp right now.
A lot of content for a separate episode is how Airbnb is breaking the economy, I think. So as you said, a lot of people bought Airbnb properties, let's call them that, just to rent them out and get some extra income during the pandemic as well, and to profit from that. And now, as you said, they're sitting on those mortgages. They still have to refinance. I've been following a lot of YouTube finance influencers who've exactly been advocating that, but now the margins are being squeezed. Like, you can't create a proper return. We're now competing with bond yields of 5.5%. And, mortgage or real estate income is 5% at best, if you're lucky, right?
Just give you an example. Right here in Austin, Texas, there's 3,330 or 40 homes for sale right now. But there are over 12,000 Airbnbs. Now, those people own those too now, okay? So, and they're slowing down. I saw the vacancy numbers on the Airbnbs. I'm sure it's everywhere the same way. And so what happens is, if you keep that for a while, that Airbnb, and you don't have anybody in it, and you're going to have to feed it, then probably you're going to look at selling it.
Absolutely. And Austin was one of the hot markets during the pandemic as well, I believe. A lot of companies and people moving to Texas. So that name and that area came up a lot when I was, looking what was going on in the markets. Let's talk about, the straw that breaks the camel's back. We talked about inflation. You brought up, maybe job cuts as well, and increasing unemployment rates by people losing their jobs, obviously. Jerome Powell's always said he's looking for something breaking, or he's waiting for something to break, right? We got Jackson Hole this week. Do you expect anything to come out of there? Any, sort of guidance?
Well, if it does, I think it would be hawkish. I think that they think that they're not there yet. If you just look at the numbers, they look at the numbers, month to month. They're just what's going on right now. Oil's up, various things. And so if they can't get the number down, then I think, if anything, it would be more hawkish coming out of Jackson Hole. I certainly don't think it would be dovish, because it's too early in the game for that. They don't have anything to fall back on. And what would really, really fool the bond market right now is if they say something along the lines of, we may have to raise again in September, because nobody believes that. And so if it happens, everybody's like, oh my gosh.
Only 15.5% believe that, by the way, based on the latest FedWatch tool. So,
well, I'm glad that you're well read. I wouldn't know the number, but I knew it was low.
I looked it up just for our conversation. I'm just always curious what the market thinks is going to happen, right? Yeah, which brings me actually to the next question as well. Hawkish stuff is like what will be a reason behind a Fed rate cut? What could be a potential trigger in your mind? Is there a top reason that you're looking for?
The top reason, I think, and I'm not trying to be a doom and gloomer here for sure, because I look at it as opportunity, but I really feel like the thing that would make them crack is if you have a big sell-off in the stock market, because the stock market makes people feel good, and that's why they're spending money now. Their portfolios they haven't made new highs like they did in early or late 21. But they still, have come back some, and I think people are using that. But you get a break in the market of 25, 30, 35% in a hurry, and I think the Fed people will be somewhat panicked, and I think that's when they would come in and say, hey, all right, we're not as bad as you think we are. We'll see. But that would be, if you ask me my number one reason, that would be it.
Sounds like it'd go hand in hand with some QE as well, because something must break then dramatically. So more free money or cheap money being, sort of introduced into the market again.
Yeah. I mean, I don't think it's been one of those things where you just slowly over time say, hey, we're going to drop the rates up a little bit today, and then a few months later, you know, that would be a true no landing, soft landing. I just don't think that's going to happen.
Well, with the higher rates right now, we've seen already cracks sort of happen, like the banking crisis. Certain banks fail. Do you think that's done with? Do you think the banks are prepared now, or could that happen again? Are we still in a banking crisis here?
I think the banks, they're not going to say this really to people because I happen to be involved also with a really, really good and conservative community bank that I think a lot of. I've been involved with it for 20 years. But I think in general, the banking business, they're really concerned because they're worried about this deposit level versus, people leaving. And then most banks right now, most of them, community banks, their loans are either flat to down over the last 7 or 8 months. And they're just sort of keeping their fingers crossed that they can hold loans where they are, hold deposits where they are. And I think the thing that would really affect them is if you went into a recession and all of a sudden you've got some loans that are going bad, because then you've got a lot of them with bond problems on the portfolio they own, and then all of a sudden some of the loans are going bad too, and that would be trouble for the banking business.
Debt servicing costs.
I would say this on this bond rally. I mean, this stock rally we've had in the banks. If I were investors, I would sell this rally.
Interesting. Okay, that's a good point. Yeah, absolutely. Yeah, that's still shaky ground here. I don't think we're out of the woodworks at all here. But I want to talk debt servicing costs as well, I think, real quick, because we're at a very, very high level for the businesses, but also the government. We're close to $1 trillion in interest fees and interest payments this year alone on the government debt. Is that something you're monitoring as well, like from the business, but also the government side?
Well, I've been watching this government debt, obviously, for decades, really. And one of the things that surprised me is how over really the last 12 or 14 years, both parties, the whole government, they've really thrown caution aside on debt. They never really even talk about it when you get right down to it. So here we are at 32 trillion. They look at 32 trillion like it's 100 grand. And I think that is our problem, that we don't have anybody that really understands the numbers. But yeah, it's going to be a cost to them. And the other side of it is, we've had major money coming in from income tax that have really helped the government. But, if you go through a recession and you've had, a lot of debt out there, it just doesn't change. But you'll have to see how it comes out. But we look at that. I think it's harder right now. It'll be harder right now, though, on private equity and private companies and people like that right now.
Private sector. So political pressure is not going to increase just yet, because $1 trillion is an interesting number to get riled up on.
Well, it is, but they don't care. I mean, yeah. So I can't. It's out of my control, so I can't do anything about it. All I can do is try to have some sort of safety valve in case they really mess up.
I want to zoom out for a second and talk about like external shocks to the markets and systems as well. I've been reading quite a bit on what is happening in China, how they're letting the market sort of frail or just flail as well. Do you look at that as well? Do you look at the global economy sort of impacting what's happening on the domestic side as well? Like, how does that factor in?
Well, we do look at it, Kai, because what happens is some of that will eventually affect what we do. As an example, you just take China. China is, if I talk to people that manufacture in China, and I've talked to a few, they'll say, you know what, I would go somewhere else and manufacture, but I can't do it as cheap as China. So China's exporting that deflation to us and will continue to do so as their economy goes slow. And that will affect us, affect the dollar, it'll affect everything. And I think people forget about that when somebody's hurting, a person or a country or a company, they do something about it to try to make it work. And what they're doing with it, I think, is they're going to try to, keep keep selling at a low price, try to beat the numbers on it. And they had a lot of real estate debt and that sort of thing. We've never been big investors in China or anything like that, but we've had a few stocks at times, but not many. We don't have any now. So I think that's where they're headed. Other spots, Japan, coming alive, doing better. They're probably not going to have to keep rates where they are because their inflation's out of line. But it's worldwide. I mean, it's obviously Europe's having a tough time, and so for us to think that, hey, we're going to be able to just keep right on rolling and nothing happened in the U.S. is sort of thinking that's out of the box, probably.
It's interesting because it sort of fits the de-dollarization debate a little bit because everything is very U.S. centric. Mm-hmm. But it seems to be the world's decoupling from the U.S. dollar. We're seeing that with the BRICS now. They have their own meeting, later this week as well. Could be some interesting news coming out of there. So it all fits the theme because a lot of conversations I have, of course, are very U.S. focused without much discussion around what is going on in the world around it. Right, so I'm always looking for external shocks. It's always refreshing to zoom out a little bit and see what is happening just outside of our little, universe here as well. Is there anything else you're monitoring? Anything, Saudi Arabia politics, geopolitics, maybe as well that you're having an eye on?
Not too much. I mean, I know people look at the dollar and everything, and I have, there's a lot of talk about a new currency and that sort of thing. Now, I'm sure the R and the C in that BRIC would really like a new currency. I mean, they would be their long-term goal. India as well. And I think people, after they saw what happened with Russia and the reserves that got frozen, that sort of thing, I think they're like, you know what? They can do it to anybody. And so I think long term, that's what they're thinking.
Yeah, it'd be interesting. I don't know. Like, I'm not in the camp that they're going to announce a gold-backed currency anytime soon here. So, but definitely interesting saber rattling, or I wouldn't say saber rattling is the wrong term, but there's stuff going on, right? Wow. So quite interesting. We haven't talked about one category or asset class yet. That's commodities as well. You touched on oil briefly, but we haven't really talked about gold, silver, the precious metals, because I'm curious how they fit sort of into your portfolio strategy, especially over the next 6 months, since you're expecting some market turmoil here.
Well, in all three strategies, Kai, that we have either gold or gold miners. Now, in the equity strategy, we don't own the bullion, but we do own the miner. In the other two strategies, we own both. And I think people have sort of given up on gold because if you laid out a look over the last 2 years or so with government debt, et cetera, everything that's going on, you'd think, man, that should have been the perfect playing field for gold to go to super new highs, which it's had a pretty good year. I mean, with everything that's going on, but I think stagflation will help gold. And I think it'll help the miners. I think people to a certain degree are like, hey, I've given up on it, and maybe it won't work this time, but we think it will.
Gold miners are so unloved right now. It's like I come from the junior mining space personally as well, and I've never seen it like that. Like, nobody cares. And you have Newmont in the S&P 500, one of the worst performing stocks in the whole index. Nobody cares.
But a great dividend. We own some Newmont. We bought at this high dividend level. Is one of a number we own. But I think people don't realize if they could do the numbers on these companies, Kai, and we look at price to cash flow. Price to cash flow on gold mining companies is at levels we haven't seen in many decades, actually. And they're really, really cheap on that level, and nobody owns them. Okay, they're like oil; nobody owns them because they gave up on them. So, if people decide that they do want to own them, and certainly large investors, you could have a lot of upside in the miners and the bullion, for that matter.
Yeah, there's a lot of double leverage. You call it a double whammy, stealing that sentence from Anchorman here, but it could really turn into a double whammy in that regard. I'm a big fan, of course. I'm heavily underwater as well in the miners, but long-term investor here as well. Ted, going into the fall, and I've hinted at the market turmoil or I mentioned that you're predicting a market turmoil here in the broad markets. How should investors be positioned? What should be, or what's in your opinion the ideal portfolio mix going into the fall?
Well, right now for us, Kai, it's this, and that is we have a very high percentage, and I'm talking about 50%, that is in the short-term treasury. If you look today at the 3-month treasury, and this hasn't happened in a long time, I would probably have to go back 30 years to try to remember this, but this is the first time that the 3-month treasury yields more than the 6-month, the 9-month, the 1-year, 5-year, 10-year, 30-year. It yields more than the earnings yield on the S&P 500. And so that's where you are right now. So if you're sitting there, and we have a lot of floating rate treasuries, which adjust weekly. But if you look at that, that's a place you should be for starters now. Not that you shouldn't have some, we think, longer term as well. But when I say some, I'm talking about 10 or 12%. I'm not talking about, half your portfolio, because eventually they're going to break. And you'll have to have that set up. But right now, they're paying you so much money on the very, very shortest treasury that's probably where you should have a lot of money, because eventually the tide will turn. And certainly if you get a break in stocks, everything's twist then at that point. The bonds really rally, the rates come down, but you have great opportunities on the stock side. And I think that's what you have to keep in mind.
5.5% bond yield, a 15-year high. I heard this morning, I think listening to Bloomberg or something. That's outrageous. Like, why isn't everybody jumping on that opportunity? Especially a lot of banks are still paying zero interest on money in your account.
I think people get lazy. They just don't they don't look at it. I mean, I see a lot of money that's basically earning very few basis points at a lot of the banks, and they have it there. It's safe in the bank. They don't think much about it, but they need to, because if you had $1 million 2 years ago, you were basically making, if you want to look at it like this, $10,000 maximum you were making in a whole year. Well, now you're making $110,000 or $115,000 on $2 million. And so that's where we are. A lot of difference.
And that's why there's Oxbow advisors, obviously, well, because you actively manage.
We do, yeah. We don't buy many ETFs. I mean, it's primarily straight bonds, straight stocks, golds, same thing.
Fantastic. Ted, what a wonderful conversation. This is great for me to catch up on what has happened in the last few months here in the market, or last few weeks actually in the markets. Really looking forward to, to see more, or actually future conversations with you as well. Really, really enjoyed it. Where can we find more of you, Ted?
Kai, the best place for us is just go to the website, which is oxbowadvisors.com. And you'll see everything there. You'll see any research we put out every quarter. You'll see a lot of interviews, a lot of books we write. And they're all about finance and investing for the person, for the individual. So that'd be the place to go, really, if you want to really get the whole package.
Fantastic. Awesome. Ted, I really appreciate your time. Thank you so much for coming on. Let's do this again before the year ends and see where we're at and how the predictions have turned out. Thank you so much for your time.
All right, Kai. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.